Started streaming. Now can you check?
Yeah.
Both should be visible now. Both streams should be visible, and our voices should also be coming.
It still hasn't started out, right?
Mm-hmm. Okay. I can see that it's going. It shows 30 seconds
Yeah,
since
now
start.
it's live. Now it's live.
Usually YouTube server itself takes a bit of time. So I just have what we'll do is in 40 minutes because we are pressed for time. Um, we will do this. You can see on this on Gmeet, right? So I'm sharing everything on
Yeah.
Gmeet, and the same stream is going to YouTube as well. So today we will do two things. We will look at this sheet. So I hope you have loaded this sheet on your laptop and you are ready. But before
Yes.
that, we'll run through this one because we'll ask last couple of times we haven't been able to show this one. So I don't know. Share this tab, and then I'll just put this tab into presentation. Can you see this presentation? Relative
Yes.
value.
Yes.
Visible. Acha, chalo. So relative valuation. So couple of things that people always want to pick it up. Relative valuation became really in the vogue or in the popular culture after there was a TV series, Scam 1992, where Harshad Mehta very popularly talks about relative valuation once, but relative valuation has always been in people's attention. A lot of people try to value the equities in the market in a more what to say artistic way. So one way of valuing, for example, um, industries which are uh, heavy in terms of entry barrier. For example, if you want to start a new telecom company, it is not just about how much money you will spend in trying to get this thing. What do you say? Setting up mobile towers and broadband and stuff. It's also about getting government clearances. So if it takes whatever some amount of time to get a government clearance, then you have to also budget that amount of time into the market value of the current company. That if you start your own telecom company, then you go and file an application that will launch Prashant Tel. Then it is not overnight that you'll get a license and you'll start working. You'll take spend a lot of time there in getting clearances and licenses and stuff and working. So then existing, so the value of Airtel or Vodafone or Reliance, and I am now talking like your video is gone. The moment the video goes away, the screen shifts. Okay. Yes. What happened?
I just got logged out. Yeah. Can you hear me?
Yeah, I can hear you. I thought your power went or something.
No, 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 no. I just got logged out. I was just logged out.
Acha. Chalo. So whenever you have because this is a question I saw when I was going through the recording of last class. You asked that a company, suppose the company is 8.77 times its current market value. What does that mean? Will it require 8.77 times the kind of money it generates to buy itself? So my answer is look at the company. For example, look at MRF or Apollo Tires from a bank or a person who wants to buy. So imagine a
Okay.
company is like a mobile phone, for example, right? A company is like a is an object, and you want to buy it, and you want to buy a product, and you want to make money out of it, and then you want to sell it. The moment you have made enough money out of it, you have broken even, and then you sell it for some profit. That's what people do, right? They buy products, raw material, then they sell finished goods. So for example, if you want to buy that company and then sell it, and that is your objective, then what do you want to focus on is that how quickly you can make money out of it and how quickly you can sell it and get out of it, for example. So if that is your objective, then how quickly the company will be able to make you money. So if a company has 8.77 as a multiple or 9 as a multiple, let's take easy mathematics, then that means it will take you 9 years to make the money that it took to buy it. For example, if a company makes 10 rupees free cash flow today, for example, which you can take out from the company and still the company continues with the as it is, then and if you spend 90 rupees to buy that company, it will take you 9 years to extract that 90 rupees and still the company will be as it is, and you can then sell it off the company, no better no worse than you bought it. So that is what we call as multiple in terms of amount. So you are now looking at a company to buy it, but usually people don't buy company to break even. They buy company to make money out of it and then sell it, right? So if you spend 90 rupees to buy a company and you want 10% out of it, at least returns, in 5 years or whatever x years, so then you want to sell it at 99. That means, and the company makes 10 rupees per year extra free cash flow, you have to spend at least 10 years to get like 100 rupees, and then that extra on the 10th year when it will make extra 100 rupees, then you will make extra 10 rupees because you already spend 90 rupees down the line. Then you will get 10 rupees after you end of 9 years. So till 9 years you are minus 90. So imagine it's like minus 90 plus 10, 10, 10, 10, 10, 10 after 9 years, then you make some money. That is what I'm trying to say. So that is how the companies are valued in the market, which is either revenue multiple or profit multiples. Software companies are also measured in some other common multiples as well, like monthly active users. So you can go and say that, hey, I am the founder of this startup or this fintech or this mobile app. We are pre-revenue company. That means we are not making any money, but we have 100,000 customers. We have 1 lakh users, and so our users will be able to spend up to 100 rupees in their lifetime. So currently, or 1000 rupees in a lifetime, the 1000 into 1 lakh is whatever 10 crore rupees. So our company currently is worth 10 crore rupees worth of users. So we are valuing it at whatever x rupees, for example, even when you're not making any profit. But if we do profit, we can make so much money. That's one way of valuing the company. Is what is the net current money that you can create out of the current base. Now comes the concept of relative valuation, is that and commercial thinking. So this is mentioned in chapter, I think, Ashwat Damodaran, chapter 7 to 9, and business analysis and valuation covers it in chapter 11 and 12, right? So they talk about PE traps, which is price to earning traps, and why PE is a misleading page fit, and why PE is a misleading multiple. Then they talk about PEG ratio and why PEG ratio is a good automatic zoom is better, yeah, and why PEG ratio is a good example that if you divide by growth, then you can differentiate between companies which are growing fast versus companies which are not growing as fast. Then you have growth versus value and market expectation. These are the 4 things we will cover today, and then we'll quickly go to your sheet, right? So first thing, so what is the PE trap? The 5 ways the price to earning growth ratio misleads. A lot of people talk about when they are valuing company from the business investment perspective as well as from the as a client perspective. If you're looking for a company to become your client, what are something? I think if I can make it single page view, that will suit it. Mhm. Um, yeah, this will be better. This way there is no doubt. Yeah. So first is PE ratio is the most quoted in the stock market, and it's the most misused ratio. Why? A PE or price to earning ratio of 30x sounds expensive. So a company doesn't make. So if you have a salary of 20 lakh rupees and you save 1 lakh rupees, for example, per year, and you spend 19 lakh rupees, so your savings is 5%. I'm just a human example is the best example when comparing to companies. So Prashant has joined a company at salary of 20 lakh rupees. So what is Prashant's free cash flow? 1 lakh rupees. Whatever you save, that means 19 lakh rupees you spend every year. 1 lakh or 8,000 rupees save per month. That means Prashant is suppose 25, and Prashant will work till 60. So you will work for 35 years. So you will
Yeah.
make. So I feel Prashant's. If I want to buy, metaphorically speaking, someone like Prashant, what is Prashant's market value?
Mm.
Prashant's market value is 35 lakh rupees. Because in 35 years you would be able to create 35 lakh, 1 lakh rupees each year.
Mm.
But that may not be true, because if you have a lifestyle where you spend 19 lakh rupees, next year your salary becomes 40 lakh rupees, your lifestyle will still be 19 lakh rupees. So next year your savings will not be 1 lakh, it will be 21 lakh.
Mm. Mm.
So, but if I take your value as whatever you are saving, and what is the free cash flow here, 1 lakh rupees, then uh, and, and I value you that currently Prashant is worth 30x currently. It sounds very expensive, because if someone spends 35 lakhs on you, then you have to spend whole lifetime to repay that money back.
Mm.
If you take a 35 lakh rupees loan or whatever, which is, and you pay back every year, it's very expensive. But if the earnings are growing at 35% per annum, if your salary is growing at 35% per annum, that multiple is cheap.
Mm.
So look, your current market
Right.
value keeps on changing because your salary is rising, your costs are not rising.
Mm.
Similarly, a PE of 8x sounds cheap. So a company who's currently, what is PE ratio? The current market value of the stock. Suppose the Infosys stock is worth 4,000 rupees, or this stock is worth a stock is worth 100 rupees, which is an indicator of market cap, and earnings per share is EPS, earning per share. And if the earning is suppose 8 rupee, say 100 rupees, and if the price, then that means PE means price to earning is 8 times, which
Mm.
means that what people have invested in the stock in the current market value, at the current earnings it will take 8x amount of time for company
Mm.
to create that kind of value, because market value or the current traded value of stock is not the book value, it is what people perceive, it's a perception. That's where psychology comes into picture. I perceive SBI to be this, I perceive gold to go up, I perceive crude oil to go down. It's a perception, there is no scientific basis, they don't use scientific formula for that. So that's the
Sure.
reason a PE of 8x sounds cheap. That means, so for example, if you have 1,000 rupees and I in your demat account, and I say, can you go and buy a share? So suppose there is one share of an expensive available at 1,000 rupees. You can only buy one share. Suppose there is a penny stock of 1 rupee. You can buy 1,000 of that penny stock. So if that penny stock doubles from 1 rupee to 2 rupee, you will make 2,000 rupees.
Yeah.
So you will
Easily.
99% of the people will go and buy 1,001 rupee stocks. Some small in the small sponge iron plant, some small soft toy, some small utility. They will not buy 1,000 rupees, um, whatever, blue chip stock or something, because they will get only one stock. There is no fun in having one stock because you can't sell it. You can't sell it and buy more. You can only sell it once, then you will have zero with you. But what it's saying is that it doesn't mean that a 1,000 rupees stock is overvalued. It just means that it will give you similar returns that a 1 rupee stock will give to you.
Mm.
If one is the absolute value of price, secondly is the value of price to the earnings. If the earnings are falling, then the whatever price you have invested, you will not be able to recover that money back, because the stock of the company will keep on falling. So if you have bought it at suppose 100 rupees, you will always want to sell at 100 rupees or more than 100 rupees to make some money, and the brokerage charges. So you want to sell it at maybe 103 rupees to make 3 rupees brokerage charges and break even. But the company is currently trading at 99, 97, 98. You will keep on holding it till it goes up, and it will never go up because the earnings are shrinking, and the earnings are shrinking. So every quarterly the CEO will come in the quarterly investment call and will say that we'll try to make some money next year, next year, next year, and they will never make money. So this is a value trap. So because PE has no memory of the future, so always ask what is the growth rate in the PE. So use something called as PEG, PEG, which is P by E by G. So you divide by growth. What it does is it ensures that a high earning uh, growth rate company PEG ratio comes down, whereas a low earning low number PE 8x, if the earnings are even lower, growth rate of earnings is still lower, it shows up that this is a very high expensive stock, for example. Second is debt. So we assume that a company will have infinite line of credit, which may not be true. Um, PE ratio ignores debt. Two companies with identical PE ratio will have different capital structure. If a company has zero debt, it doesn't have to make any interest payments. Uh, it may not have interest tax shields, but it will always have a very low risk profile compared to company which is heavily leveraged, because the moment they have an external shock like raw material supply costs going up or the threat of being replaced, they will not be able to issue discounts, spend on marketing, promotions, extended line of credit, etc. Highly leveraged companies will suppose someone is building a big factory and that product which is coming out of factory is no longer in demand, so then the entire factory is waste of money and time and space. So then they are stuck up with that plant for a long time. So that what companies are doing currently, and you would have seen that in COVID as well, concept coming up as D2C, where people just make something and ship directly. They don't own the manufacturing utility. They manufacture from outshoring or nearshoring or sending it to China or something, and then making stuff and then just putting their own label and just selling it. So in those cases, when debt is ignored in PE, always we should take EV by EBITDA. We have seen EV by EBITDA ratio last time to see how the capital structure neutral comparison can be made, because EBITDA doesn't take into account the interest tax shields, taxes, and the. And we have also seen how leasing helps in terms of reducing the amount of money which goes into loan payments, and because there is no asset, there is no depreciation, so there is no non-cash expense happening, so then that cash can be returned back to the investors. So companies which lease are the biggest friends of the investors. um, you will find them as good targets for leasing candidates, companies which have huge asset bases, assets whose performances get impaired over time and who need a lot of maintenance. Next is earnings can be manipulated. So EPS is an accounting number. So every quarter, if you want to show that you are earning a lot, you can start depreciating faster and add. If you want to show lower earnings, you can start depreciating faster, and you can have a non-cash expense, and then you can add those expense and then show it as a free cash flow, but it will not be an actual expense coming in. Similarly, if you want to show high earnings, you can depreciate slow, and then that in that case you will have very low expenses coming in for depreciation, and then this EPS earnings can be shown as very high in a quarter. Usually people do not, good companies do not show high earnings because high earnings lead to high taxes. Companies always try to show that they are in debt or in losses, because in losses you don't have to pay taxes, or when you are in debt you get interest tax shields. So depreciation policy, it's usually 10 years for something, some assets, 20 years for something, certain assets, 4 years for computers and laptops and IT assets. So depreciation policy, again, it's not hard and fast, but whatever it's defined in the annual report, that has depreciation policy plus INDAS or whichever accounting standard they are following, revenue recognition timing, and exceptional items. All these can distort an earning. So one-time asset sale can inflate the EPS. A write-off can destroy it. So purchasing a stock on PE is meaningless, or a distorted EPS is meaningless because the EPS can change. So to normalize EPS, we should use cash EPS. You can calculate cash EPS or trailing 3-year average. If you are taking only EPS, then take 3-year average, because they cannot be depreciating something or not depreciating something 3 years in ago, right? So finally, PE doesn't work for loss makers. If EPS is negative, PE is undefined. So many high growth companies are unprofitable by design. They do not want to pay taxes and they want to plow back all the earnings that they are making in terms of equate growth. So whatever money you make, you spend in acquiring new customers or by giving discounts and building a moat or spending all the money on R&D. So if you are a startup, you can say that every penny I make, I'll spend it on my making my product better. I'm not here to make money and get more salary or return it back to investors. I'm here to build a company for long term. So then they're unprofitable by design for next 5. You can tell that to investors as well that, and we are not going to make money for next 10 years. We're just going to lie low and build strength. And then using P to compare a startup with an incumbent is a category error. So you cannot compare a startup with a large giant in an industry. First, if you want to compare a high growth company, and usually incumbents are really scared of these startups who are really fast growing and who are making products which are relevant for the customers. So because you're comparing a future bet to a present cash machine. So this is like comparing IBM to Red Hat, for example, or IBM to AWS when it was very small, right? So someone which is growing fast and not making profit compared to IBM, which has always made profits and given dividends. So sector PE varies enormously. So a PE of 15x is expensive for a commodity business because commodity business doesn't have any moat. So people can the product is elastic. The price elasticity of demand is low. That means the product can be quickly switched, and it is cheap for an FMCG franchise. So um, comparing PE across sectors is meaningless. So within a sector, capital intensity, asset life, cash conversion differs significantly. So comparing PE only within sector, if you want to still compare PE and adjust for growth. So if you want to compare, suppose Marico, then you should compare Marico with something like Dabur, or because if they are both are in hair oil or coconut oil segment for that matter, and they are all sourcing copra from India, from the raw materials coming from some single place, and if the product size are similar, a lot of things come into picture. If they are all making um, homogeneous products, if they're all sourcing raw material from homogeneous places, a lot of things comes into picture. Only then you can use P. Without, even then you should take growth rate into the picture. Next is comes our PEG. We have been talking about PEG for a long time. So what is PEG all about? So PEG is PE ratio divided by growth rate. So if PEG is less than 1, that means the company is undervalued. Quickly go ahead and buy it because very quickly it will become PEG
Correct.
1 and PEG greater than 1. And it means market is not pricing the growth, market has not read the growth statement, or market does not know what the company has procured and secured as a long-term raw material for themselves. For example, if an iron ore company has acquired a steel mine, uh, and then that means that they will be able to reduce the steel milling cost. Or if a steel plant, or if a steel plant has acquired an iron ore in Andhra Pradesh or Visakhapatnam or somewhere where there is a lot of iron ore within the ground, then they will be able to acquire, and they have acquired environmental clearances, permits to mine and whatever, then they can source it cheaper. So suppose Steel Authority of India Limited has a Visakhapatnam steel plant and they have iron ore plants as well. Tata Steel does not have, or Jindal JSW Jindal Steel Works, they do not have. JSW come to campus a lot recently. Tata Steel also comes to campus, but suppose they do not have raw material, then they will not have um, long-term benefits. The moment iron ore prices will go up, Steel Authority of India Limited, Visakhapatnam Steel will still make money, or Salem Steel will still make money because they can still get the iron ore at cheaper prices. Others can't. That means the market is not pricing the growth because market does not know how the business work. But you as an analyst or you as an expert know that the moment the going gets tough, these stocks will rocket. So then you should buy these kind of customers. For example, these kinds of company which have customers um, which have vertically integrated in strategy. We call it vertical integration in terms of raw material to finished good, and you are paying less and getting more in terms of stock. So PEG is this ratio, P ratio divided by expected EPS growth rate, earnings growth rate, and growth rate is retention ratio into return on equity. You retain more and you grow faster on whatever you have returned. Apollo Tires P ratio 18.2 and MRF 28.4. So at 18.2, you will feel that it is undervalued. MRF is around, let's ease of mathematics, 20x P to P ratio, but then its growth rate is 8%. So its PEG is 2.28. It's very overvalued. Compared to MRF tires, it's growing at 22% per year. So at PE ratio of 28.4x, at 22% growth rate, 3-year PAT CAGR, which is a very high number. See, MRF PEG comes so low, even if higher PE ratio, but very low PEG, because the growth is very high, low growth rate. Classic example of comparison. So if you buy MRF stock, you are buying, so your money is growing at 22%. You are buying Apollo tires, you are getting more stock, but your money is going at 8%. You will always want to, your thousand, because it doesn't matter. So if suppose ₹1,000 you will get one stock of MRF or two stock of Apollo, the ₹1,000 itself is going at 22%. If you are planning to buy and hold it for 1 year, it will grow at 22%. Simple mathematics. So high P is justified by high growth rate, 20% CAGR exceptional for 70-year-old tire company. Market is paying for quality of earnings. Here, commodity cycle, low growth rate, EV EBITDA is very cheap, but it's a cyclical business, very volatile PAT here. Classical example of growth adjusted P. Never buy only on P, buy at PG. And always understand try to read what the industry is all about. Now comes the Damodaran Gyan or knowledge here. So what Damodaran says is that value is equal to assets plus earnings power plus growth option. So each component is priced differently. So if you do value investing, that's where Benjamin Graham and Damodaran they both come here in the picture, and they say they pay less than intrinsic value. They focus on asset and earnings power today, not on projected growth. So value investing is something you buy today and hold for next 20 years. You don't sell it. So you sustain yourself by the dividends and by the earnings. So a lot of people who do not have pension, they earn by the dividends. They are elderly people, retired people, especially in America. They buy IBM because IBM always pays dividends, and it has always pays dividend. It's a 100 plus year old company. I think for past 60 years IBM has always paid dividend. So if you have enough IBM stock, every quarter you will get so much money that you can survive your bread and butter if you are an old person with the dividend money. You never have to sell the stock. Just buy the stock and hold the stock. That's all you have to do. So in India, I think Tata is a stock. So if you are a youngster in 1970s and 80s, if you have purchased Tata, you can retire today and only live on the dividends paid by Tata. You never have to sell a Tata stock. And no Tata company will ever go bankrupt. They are that well run, and the executive, the structure, business function is so well done. That's value investing in a nutshell for you. Signals are low PE, less than sector median, low price to book value. This is P by B ratio. High dividend yield. That means they need high dividend yield, and they are only valuing the company on dividend. That means the company should always pay back and take care of the people who have invested their money in. You can also think about such companies which do not spend. They are usually not IIM or NM or SPJN campus visitors, because any company which gives very high dividend yield will not have a lot of money left to pay good salaries to employees, because you have only so much money. If you pay dividend, then you will not have. You will have a very lean. Usually, you will have a lean or a balanced employee pay structure. They must have proven cash generation. They should have low debt, or they should be in an industry which does not require huge amount of investments coming in. Value trap, low PE, because business is generally declining, so cheap for a reason. So this is a value trap. Be very careful when you are looking at companies with low PE but low growth ratio as well. So Apollo falls here in value investing. So it's a capital intensive structure, rubber industry or automotive equipment manufacturing. But um, you need to look at whether the company is able to ensure the growth rate in the future. Otherwise, it's not a good escape Apollo for that matter. Growth investing is pay for a premium for above average future earning growth. That means that even if the PE ratio is high, pay that money, because the company will grow faster and you will be able to make more money. High PE ratio, high price to book value, the company which reinvests all cash. So this is growth investing is for youngsters which do not want money, and this is because If you get more, you are anywhere having 20 lakh rupees or 30 lakh rupees salary. We are in taxable bracket. So suppose you don't want more money. If you get company which pays you more money, you have to pay more taxes. You want company which does not give you money, but the stock price keeps on increasing. Because the stock price increases, then you don't pay any money. I'll give you an idea. So if you purchase a stock of 1,000 rupees, and suppose you purchase one stock of Infosys or whatever at 1,000 rupees, and they give 10 rupees as dividend or whatever. So you have, but then 10 rupees come to your bank account. What if they do not pay you 10 rupees, but the stock value goes up by 500? It becomes 1,500 rupees. You don't get that money, but you still have 1,500 rupees worth of stock in the market. So you will always want a money which stock value goes up but doesn't pay any dividend, because dividend carries taxes. Is that clear? So this is the company which
Yeah.
reinvest. If you would ideally want them to reinvest all cash with to themselves in growth and not pay you back. Here they want high dividend yield. This is for elderly people who want money on time, because that's how they live. Make sense?
This is true for, I think, US. No? Is it also true for India?
Yeah. So if you are if you are a youngster, and if you suppose if you are anyway getting some money, you would always want money when you do not have when you have lesser money, or when your money is lesser than the income tax bracket. For example, if you are making less than 12 lakh rupees, then if you get this money, then you will not have to pay taxes. 12 lakh is the 12.5 lakhs is the taxable limit. So if you are making 11 lakh rupees from your salary, and suppose you get 2 lakh worth of dividend, then you have to pay taxes, because you will go beyond the taxable limit. So you would rather pay 2 lakh and not pay taxes. Suppose you are a retired person, you have zero money, and you get 2 lakh rupees dividend, then you don't have to pay any taxes, right? It's full free cash to you.
Okay.
So suppose let's take example of your grandfather. Or suppose example a grandfather you imagine of you. So Prashant has a grandfather who earns nothing. For example, a 90-year-old grand, he gets 2 lakh rupees from a stock. And Prashant gets 2 lakh rupees. Prashant, I total income is 22 lakh rupees now. Because it is more than 12 lakhs, Prashant has to pay taxes, 30%. But your grandpa pays nothing, na? Because his income is zero.
Because he belongs to a different tax bracket.
No, he is retired. He doesn't have any income. He has zero income.
Yeah.
So for him, 2 lakh rupees is below 12 lakhs. So he doesn't have to pay any taxes. Make sense?
Yeah, now it makes sense. Also, what about companies that pay, if an entire sector, or maybe, what if stock market in a particular country always pays low dividends compared to another country?
Usually stock market is not a stock market phenomena. It's a company phenomena. Some companies pay low dividend, some companies pay high dividend.
Okay,
It's a company, it's a CFO choice. It's the choice of a CFO. Whether we will pay dividend or will not pay dividend, it's the choice of a CFO. So if for example Amazon said that, Jeff Bezos said that next 20 years will not make any profit. We'll invest everything, we'll grow, we'll become the most modern company in the world. If you want to invest in us, otherwise don't invest in us. It's a choice. Nobody is forcing you to buy my stock. But I am telling you, I am launching a company called Naval and Sons Private Limited, or Naval and Naval Private Limited. For next 50 years, I am not going to pay you anything. But we will become the most modern Tata or Volkswagen of the world. 2076, Naval will be the most modern company. Are you willing to hold, for example? Nobody will hold. Then don't buy. I'm not forcing you to buy my company. Buy stocks in my company. Not 50 years, suppose 10 years. I'll not pay anything till 2036. That's an example. Make sense?
Yeah, now it makes sense.
So two companies make sense: value investing versus growth investing. One who pays high dividend, one who reinvests all cash. So what you do with the cash defines what kind of investment company you become. Revenue grows because you reinvest all cash in your own business. Your revenue will grow faster. You'll invest more shops. You'll invest in your employees. Invest in new technologies. Make sense? So then the ROC will improve faster. So these kind of companies are called growth investing companies. MRF is a growth investing company.
Mm.
So people who talk about this philosophy is Phil Fisher and Peter Lynch and Tom Rowe Price. These three names are mentioned in the top. Benjamin Graham and Damodaran, these are all value investors. Make sense? Am I
Yeah.
audible? Yes? No? Okay, chalo. So I'll stop here. I know it's actually I have a couple of minutes. We'll cover this. We'll cover your sheet maybe market expansion core concept. ठीक है. We didn't have enough time to cover this part, but why don't you quickly walk us through in 3 minutes? Give us
Three minutes.
give us. I know I'm giving you very less time, but
Mm.
let's do a 3 minute blitzkrieg of this. But we have covered what
Sure.
we have wanted to show. Over to you. I'll do
Yeah.
full screen. Yes.
So yesterday I was looking into multiples, right, for relative valuation, and GPT. I had to consult GPT, and it also said pretty much the same thing, which is that PE ratio is not a very robust measure. So instead, what I did was I just charted all the differences that these companies had endured over the last financial year. So I made a list of whatever things I have observed, and I have made a list of whatever things that GPT could find which I couldn't observe into a sheet. And then I took EV by EBITDA and debt to equity ratio. Now there's no reliable findings for the sector, this thing EV EBITDA or sector PE. So I did not dabble in that. So this is what I did basically.
Okay. So what I'm seeing here is revenue here, EBITDA here, and then you have ROE 8%, return on equity for Apollo, 10% here for MRF, EPS here around 18, around 4400, and 235 rupees is per stock price, 5 rupees per stock price. So then if you do the total debt and then debt to equity is around this much, interest coverage is good, current ratio is this much. So with this, if we come back here in the very last moment, I'll just summarize the two stocks here. So Apollo tires and MRF tires. So here P ratio reasonable, this is premium here. PEG ratio very costly on growth. It's fair value on growth because it's growing faster. Then you have EV EBITDA. It's attractive here on EV EBITDA. Here the multiples are high. So if you are only focusing on EV EBITDA, you will buy Apollo tires because it has a lot of debt. But always understand that if the company is not able to pay debt on time, it may default. So the price to book value ratio is very good, very low, which shows that the market is not expecting this company to grow faster or grow much better. Well, this is very high, 5x the price to book value. EBITDA margin, this is kind of similar, 14-15%. PAT margin similar almost. CAGR PAT is exceptional here, nearly 3x growth. It's growing almost like a software company, 22%. ROCE is also kind of similar. Debt to equity ratio is debt free. MRF is debt free. This is the comparison of these two. And then question was who is the stronger borrowers? MRF tire is the prime borrower. Apollo tire is is a conditional borrower. So if strong
I
borrowers,
think we established this last session as well, right?
huh, huh. So the question was who will pay us back and if things go wrong, who will buy? The point is, and the angle is that those who are the prime borrowers they never ask for loan because they are anyway in good condition. So those who are not prime borrowers, they are good candidates for leasing because they are not good candidates for borrowing. And then commercial thinking is what does the market expectation achievable, happens if it's missed, how does the business generate enough cash, what structure tenure and covenant fits its credit. So this is where you make your money or all the financial analysts make the money. You structure what kind of loan. It's like study loan, 15-year loan, 10-year loan. Then summary is P is not noise. Three sources of value every multiple: price to book, PE and PEG. High multiple is a dangerous borrower. Low multiple is safe credits. And commercial thinking is translate ratio into deal structure. And deal structure is this one. This is the deal structure. What kind of stock loan, how long it, and what kind of um, agreements you want them to sign so that you have your debt secured. With that, unfortunately, we have come to the end of the session. We will stop our PowerPoint presentation and we will end our stream. Thank you, everyone.